Many will have heard of tilt in poker, but tilt in trading is probably far more devastating if not handled well, and it can take a long time to recover from the consequences. Trading tilt is a phenomenon which tends to affect traders who are more active in the markets, those who take multiple intraday trades. This is because a trader has the ability to enter the market at any desired moment, and so there's very little time to disrupt the tilt process once it begins, or for strong emotions to fade away. Trading tilt is when a trader acts in a heightened emotional state. It's when you're unable or unwilling to control your emotions in a logical manner and are driven purely by emotions. It's generally recognized as an active process where a trader is compelled to take poorly thought out or rash trades. But it can also be argued that there's a passive type of tilt, where emotions prevent you from taking trades at all. I'm of the opinion that true tilt is about not being able to control your actions. And this is what we're going to focus on here. To get a better idea of tilt, think of a trading scenario where the internal conversation goes something like this. "Oh man, not again. I don't believe it. Well, I'll show you." And then you take a poor or rash trade out of anger or frustration. Trading becomes aggressive, and all respect for risk goes out the window. Now, if you don't recognize this, think about an argument that you've had in the past with someone that you cared about. Now, I'm confident that most people will have at least once said something in anger which they truly did not mean and would take it back if they could. But in the heat of the moment, they were unable to think logically and they were driven by strong emotions. Now, going on tilt may or may not have an immediate impact on a trader. In fact, it's probably worse if the trader makes money in the beginning, irrespective of this type of trading. If they do, bad habits start to creep in, and even worse, strong emotional responses to certain situations become second nature. Financially, the fallout from tilt can have a huge impact on the expectancy of a strategy. It only takes a few blowout trades to really skew your performance. When this happens, it also leads to traders starting to snatch at their winners as well. So the effect is doubled by taking smaller winners and larger losers. That's not a great combination for making a living out of trading. A number of common triggers for tilt exist. Unfortunate stop-outs right at the extreme of a swing or the day's high or low can be pretty frustrating. When a trade is onside and comes close to its target only to end up a full loser or worse, it can sometimes be difficult to take. Buying what looks like an exceptionally strong rally only for the market to turn at the very price you entered at, and even perhaps it ending up at the high of the day, it can really provoke strong emotions. Missing a number of legitimate trades only to take a loser as soon as you actually take one also has the potential to trigger tilt. Whether it's just one or a combination of these scenarios, the likelihood of tilt being triggered is heavily influenced by a trader's current susceptibility. There are a plethora of reasons why a trader might be more susceptible. Trading with low amounts of capital can mean that each trade has a big impact on your account, and this can lead to being too dependent on the outcome of one trade. Taking a few bad beats then becomes not only infuriating, but crucially, it becomes a threat. If you're experiencing a drawn-out losing streak or a period of low performance, your emotional capital could be particularly low already, and anything could end up tipping you over the edge. Of course, alcohol or other intoxicating substances, inadequate nutrition, poor quality of sleep, or a stressful situation at home could also be a problem. Trader condition plays a huge role in susceptibility of trading tilt. Tilt isn't always created by the trader themselves, though. The type of market movement is also likely to have a big impact. Seeing a trade stopped out quickly when the market hasn't really been moving a great deal can evoke feelings of vulnerability and generate a fight or flight response. This is probably one of the biggest dangers for a trader. Losing the ability to act rationally and instead acting aggressively without respect for risk, just as market volatility spikes. Increased market volatility and erratic news-driven behavior often leads to tilt and painful losses. The best advice that anyone can get who has a problem with tilt, which is most people, is that having a good awareness of how you're feeling and acting can be the key to stopping the consequences. Once you've been fully triggered, it can be really difficult to get out of it. So recognizing the signs and having mechanisms to disrupt the impact can help enormously. These could include taking a break from your screens, breathing exercises, short, intense exercise, or just having a hard daily loss limit. Honestly, though, it's easier to deal with tilt before it happens. This involves recognizing whether you're currently susceptible to tilt, the types of trading scenarios that could be a trigger, having an awareness when those triggers actually happen, and the emotional signs that it's coming. Calming down before trading tilt hits is a lot easier when you're ready for it.